right. Well, good morning and welcome to the September edition of the Beyond Wealth Advisors Economic Update. I'm John Cleaver, partner, senior financial advisor at Beyond Wealth. And with me today is Scott Hawker. Welcome, Scott.
Thank you, John.
Good to have you back.
Yeah, appreciate it.
It's been the summer since I think you've been here.
Yep, it's been an exciting summer. There's obviously been a lot going on in the markets and in our economy, so it's been an exciting time for sure.
For sure. So here we are in September. Football season started. Baseball season's nearing the playoffs.
Yes.
Lots of exciting things going on. And you're exactly right. The markets have definitely held up to what we initially had talked about earlier in this year, that we expected kind of a lot of volatility to happen. And here we are, September, and Sure enough, we've had a lot of volatility. So even just last month, as we discussed, August kind of got off to a rough start. But then, lo and behold, by the end of the month, it had actually responded and turned positive. And here we are in September, kind of off to a rough start again. We'll have to wait and see what happens here in the month of September. But just taking a quick look back to the month of August, global equities were up for the 9th time in 10 months. So when we think about what's going on in the economy, what's going on in the markets, what's going on internationally, we continue to see this kind of broadening and this growth across just the global landscape. And so that strength continued through the month of August. And quite frankly, U.S. has done well too. And so for the 4th consecutive month, large cap U.S. was up as well, approaching almost 20% positive for the year before we hit the 1st of September. And I mentioned broadening, and that's kind of been our theme, right? Because we had this run up of the Magna stocks, the Magnificent Seven, and so we've seen this broadening. And defensive sectors, including things like real estate, consumer staples, were actually our best performers in the month of August. In fact, we only had 2 negative sectors for the whole month. Small caps struggled a little bit surprising considering we're anticipating the Fed to lower interest rates. So we'll see what happens with that. And that's kind of our topic for today. As we shift into the month of September, we shift into fall, all eyes still remain on the Fed. And we're going to talk about that here in a minute, just how monetary policy just continues to shape what's happening in our economy. But before we do, give us the update on the other side of the investment world. How's the bond market doing? How did the bond market do in August? Kind of what's happening there?
Yeah, that's a great question, John. We get a lot of questions about this. In investment grade bonds, they were up for the 4th consecutive month. This is exciting. Also, something the Fed has really been watching is the inversion between the 10-year and the 2-year treasuries, and that is almost uninverted. That's something that they've been striving to accomplish. And then we've got also high yield bonds and emerging markets that have continued to also rally.
Yeah, so real strengthening in the bond market, which
absolutely
not completely surprising. We kind of expected that on the anticipation of interest rates coming down. So let's shift there. Let's turn our attention a little bit to monetary policy. As I've said, all eyes have been on the Federal Reserve. We've been watching Chairman Powell to see what's going to happen. But before we talk about what's going forward, let's just take a quick little recap. And how did we get into this, right? So if we think back, March of 2022, the Fed began raising interest rates in response to really the rising inflation that was caused through the pandemic time period. So from March of 22 to July of 23, the Fed raised rates 11 times, bringing the federal funds rate to that 5.25 to 5.5 range. And during that time, the Fed was really focused on their mandate of reducing inflation. They want to bring inflation down to that 2%. That's kind of their indicated mandate. But let's remember, the Fed actually has 2 mandates, not only to keep inflation down, but also to keep unemployment as low as possible. And really, unemployment stayed low throughout really that entire cycle. we started to see a little bit of a spike in unemployment. So now the Fed is keeping an eye on that second part of the
Mm-hmm.
mandate. So it's just this balancing act, right? And we hear them talk all the time about, can they create a safe landing or a soft landing for the market and the economy to kind of come together? So through August, of course, we've remained unchanged. Mm-hmm. And then at the most recent symposium out in Jackson Hole, Chairman Powell began to hint at the idea that, yes, in September, we could see our first rate cut. So that's kind of looking back, how we got to where we're at. Clearly, the consumer, just the economy, the market really kind of plowed its way through, the last 18 months or so and really stayed strong. Inflation's coming down, unemployment spiking a little bit. So if we get that rate cut in September, what are going to be some of the ramifications, positive, negative, of a potential rate cut in September?
That's another great question, John. And obviously, this is something that we've been watching very closely throughout the course of the year. And I think the pros of this, what we're excited about, is money as interest rates fall, money becomes more easily to attain, becomes cheaper, right?
Yeah.
And so what you see is a lift from new home sales because mortgage rates start to drop.
Sure.
Also, vehicle sales and just other consumer discretionary.
Money gets a little less sticky almost.
Right. It gets a little bit easier, right? Sure. And so interest rates on credit cards fall. This is good for the economy. Also, that all drives higher corporate earnings.
Sure.
And so the stock market likes lower interest rates.
Yeah.
Also, you'll see bond prices continue to rise, so you'll get some capital appreciation in your portfolios from that. There is a downside, right? So a lot of clients have had money. They've had higher incomes, driven from the higher bond prices. Those will start to erode a little bit. Also, money market accounts have been very strong in recent quarters, and that will also continue to erode.
Let's just pause on that for just a second. I mean, obviously, we've had a lot of clients have been taking advantage of this idea of being rewarded, right, for that higher savings rate, that higher money market rate, without necessarily taking on the additional risk of being in the market.
Right.
We knew this day was coming, right? At some point when rates come down, then those money market, those savings rates are going to come down as well. So that's going to cause us to think about, where do we go next, right? Potentially. We'll see how quickly rates do come down. What else is the Fed maybe keeping an eye out for?
Yeah, John, they're really watching for inflation to potentially spike back up. With lower interest rates. Again, the money is easier to borrow, and so people are spending more, and that drives up inflation. So they will be very strategic in how they are lowering those interest rates to make sure we don't end up right where we came from.
And that's really why we think they've waited so long, right? Because if they lower rates too early and we get that spike in inflation, well, then what are they going to do?
Correct.
Are they going to re-raise rates? That wouldn't be a good look for anybody. It's not going to be good for the consumer. So that when we talk about that soft landing, it's really like, how long can they go before that pendulum swings clear the other direction? And let's be honest, the Fed hasn't always gotten it right. They've reacted too early and too late. It's not an exact science. We know that. And so markets are going to react. And they've been reacting all year. We've actually, had really strong growth this year in spite of rates staying higher. So, all right, so let's transition to that. We've been talking about the economy, monetary policy. How does this impact maybe some specific markets if we do see some rate cuts here in the coming months?
Absolutely. So as we kind of spoke to earlier, consumer discretionary, that's goods, right? That will be positively impacted. Also, real estate. A lot of financials and technology. There'll be with lower interest rates. Money is cheaper to invest into those areas. Something that we've really been watching this year is small cap, waiting for these interest rates to fall. Small cap is very interest rate sensitive. And
Absolutely.
so we've kind of been waiting and preparing for
It's
small
had a
cap.
few fits and starts,
It has,
right?
it
Like, hey,
has.
let's go, but yet
Yep.
until rates actually come down, make it a little easier for
Yes.
those startups to get access to capital,
Yep.
reduce their interest rate costs for sure.
Also
So,
commodities.
okay.
They respond well to lower interest rates, and as interest rates start to come down, the dollar becomes less. It becomes depressed a little bit, slightly,
Right.
and so that's good for international markets and emerging markets. You'll see a lift in those areas,
Right.
Because the dollar is less
Yeah,
expensive.
and earlier this year and through the opportunities we've had to reposition
Mm-hmm.
strategies,
Mm-hmm.
we've really focused on
Yes.
international exposure, emerging markets through high yield, even the small cap, and really that diversification. Sometimes you don't get rewarded for that
Right.
until later when the market actually does turn. And of course, the Magnificent Seven really kind of drove growth earlier in this market cycle. But like we said early on, we're now starting to see kind of that broadening back out. Again, one of the reasons why we like to really stay diversified and look across all aspects of the market.
Right.
So,
Yeah. In particular, I think the emerging markets, international and small cap, is where we really feel strongly about.
Yeah, and you mentioned this earlier when we were talking about just the bond market looking backwards, but as we look forward,
Mm-hmm.
Again, as interest rates come down, it's simply math, right? Interest
Yes.
rates come down, those bond prices go up. And so the inverse of what happened in 2022, when a lot of people that were holding bonds were like, wait a second, why are my bonds not performing well? Because interest rates were going up. Now we potentially get the reverse of that, whereas interest rates come down, the bond prices, they'll potentially get some capital appreciation in that fixed income.
Right.
And that really speaks to, why do we stay diversified? Why do we stay balanced? If you're not a full growth investor, having balance between stocks and bonds really can pay dividends.
Yes.
No pun intended.
No pun intended. Yeah, I guess.
Absolutely. So, well, that all sounds really good. So I guess we kind of have to wait and see. I know the Fed will make their final decision here in a few weeks. Certainly, we're still on the trail of an election here in November. We're inching closer to that, and whether or not we'll get real clarity on that until we get really close to that, I don't know. That always has an interesting impact on what's happening in the markets too.
Absolutely, absolutely does.
Well, fantastic. Well, Scott, it's always great to have you here, and it's good to be on the backside of summer, heading into fall. And I know we'll be back together again here real soon. So with that, as always, take this end of the year time, find that opportunity to connect with your advisor, do that year-end planning. There's potentially opportunities to position through the end of the year and into next year as this market continues to move and evolve each and every day. So appreciate you listening in.
Thank you.